Bitcoin is moving while Wall Street is closed, and that is exactly why this bounce deserves more caution, not less. The stock market is shut for the long holiday weekend, but crypto is still trading, still reacting, and still trying to tell investors something. Bitcoin pushing back toward the low 60,000 area looks like relief on the surface. But the real question is not whether price bounced, it is whether real liquidity is coming back behind it. What changed is that Bitcoin finally got a visible flow headline after a painful stretch of selling pressure. Spot Bitcoin ETFs saw fresh inflows after days of outflows, and that gave bulls a reason to argue that the worst pressure may be easing. But one positive flow day does not automatically rebuild a trend. In a thin holiday market, a bounce can look stronger than the conviction behind it. That is where Wall Street psychology matters. Before the holiday break, the market was already showing rotation under the surface. The Dow was strong, but chip stocks and parts of the AI trade were losing momentum. That matters for Bitcoin because crypto does not trade in isolation anymore. When investors are questioning the most crowded risk trades, Bitcoin needs more than a green candle. It needs proof that capital is returning with commitment. The mistake retail investors often make is treating every bounce like confirmation. But holiday liquidity can distort the signal. Fewer desks are active, spreads can widen, and price can move quickly without the same institutional depth that normally validates a move. At the calm metrics, this is the difference between watching price and reading the market beneath price. So the takeaway is simple. This is not a clean victory lap for Bitcoin yet. It is a liquidity test before Wall Street comes back. If ETF inflows continue, if risk appetite stabilizes, and if the AI rotation does not turn into broader de-risking, then the bounce becomes more credible. But until then, the smarter read is calm. Bitcoin is moving, but the real confirmation comes when the missing liquidity returns,